Right now, the Kingdom of Bhutan is quietly using the rushing rivers of the Himalayas to mine hundreds of millions of dollars in Bitcoin, while at the exact same time, a legacy clothing giant in Maryland is losing tens of millions just trying to sell T-shirts.
Yeah, it's wild.
Welcome to NovaStream, your 24/7 streaming channel right here on YouTube. Whether you are, tracking the live crypto markets, and yes, we see those dynamic sparkline charts for Bitcoin, Ethereum, and Solana slashing on your screen right now, or monitoring global financial indices like the S&P 500, the Nasdaq Q, and Forex pairs.
Right, and commodities, too.
Yeah, we are here to make sense of the chaos. We're continuously pulling in auto-curated breaking news from the top tech, political, and financial sources the very second they hit the wire.
It is fantastic to be here with you. And if you look at the digital cityscape on the stream behind me, it's really the perfect visual for the incredibly complex, ultra-connected financial landscape we are exploring today.
For sure. And just for the record, today is Tuesday, May 12, 2026. For today's highlights of the day, we are tracking a massive, undeniable clash in the markets.
Oh, a huge clash.
Right. On one side of the ledger, we have explosive, futuristic technology, so artificial intelligence, space exploration, and sovereign crypto stockpiles. And they're commanding trillions of dollars in capital.
Trillions, with a T.
Yeah. And on the exact opposite side, we have the harsh, grounding realities of traditional finance and the retail economy just dragging things back down to earth.
It's basically a tale of two entirely different economic realities colliding in real time. I mean, we're seeing valuations that defy historical gravity right next to business models that are being crushed by fundamental supply chain math.
Okay, let's unpack this. Let's start with the absolute foundation of the tech boom, which is silicon and compute power.
Yeah.
Because we really can't talk about the future of AI without talking about the physical hardware that actually allows these models to think.
Right, the actual physical chips.
Yeah, so let's look at Micron Technology. Their stock, ticker MU, has surged over 170% in 2026 alone.
Yeah, it's been a monster run.
They just hit record highs, pushing past an $800 billion market cap.
And, the revenue forecasts driving that market cap are just staggering. I mean, Micron is projecting to exceed $75 billion for fiscal 2026.
Wow.
Yeah, that is more than a 100% year-over-year increase. Wall Street analysts are calling it a virtuous cycle. But to really understand why this is happening, you have to look at the architecture of modern AI.
Right, because as these large language models get bigger, they demand exponentially more memory.
Exactly.
And the bottleneck right now is a specific technology called high bandwidth memory, or HBM. My understanding is that HBM involves literally stacking memory chips vertically and connecting them with these microscopic wires so the processor doesn't have to wait for data.
Yeah, it's incredibly complex to manufacture.
It requires immense precision, and Micron is one of only 3 major global suppliers who can actually build it. So it's basically like selling the only shovels in a gold rush, but the shovels are completely sold out for 2 years.
That is a perfect analogy. That structural bottleneck is driving the entire market. I mean, the demand is so ferocious that Micron's entire HBM supply is completely sold out for the rest of 2026.
Completely gone.
Totally gone. And they are already booking capacity deep into 2027. So because Micron is pivoting so much of its factory floor space to pump out this really lucrative HBM, they simply lack the physical capacity to produce standard DDR5 memory.
Oh, so everything gets squeezed.
Right. Traditional memory chips are suddenly in short supply globally, which hands Micron massive pricing power across their entire product line. Analysts are slapping price targets of $1,000 to $2,000 on the stock.
But hold on, with 100+% share price increase just this year, and notable insider selling happening at the executive level, this has to be getting a little frothy.
A little bit, yeah.
Which brings us to the other side of this hardware coin. There's a company called Iron, formerly Iris Energy. While Micron is manufacturing the memory, Iron is out there trying to secure the actual processors, the GPUs.
Right, they want to build the infrastructure.
Yeah, and Iron stock has surged 720% over the past year on their ambition to become this premier AI cloud provider. But JP Morgan just came out and threw a massive wet blanket on the party.
They certainly did. So JP Morgan hiked their price target to $46, which, sounds positive.
Yeah, it sounds like an upgrade.
But the broader market consensus is sitting way up at $71, so 46 is actually quite low. And more importantly, JP Morgan maintained an underweight rating on the stock.
Underweight? Ouch.
Yeah, they cited extreme skepticism over a new $3.4 billion 5-year AI cloud partnership Iron just signed with NVIDIA.
And the mechanics of this deal are wild. JP Morgan explicitly called it a circular deal. So wait, let me get this straight. NVIDIA gives them money to buy NVIDIA chips.
Basically, yes.
Isn't that just moving money from the left pocket to the right pocket to artificially pump up the deal's value? That sounds like a car dealership giving you a massive personal loan purely so you can buy 5 of their most expensive cars.
Yeah, it makes the dealership's sales look amazing, but the underlying economics are completely artificial. What's fascinating here is you've isolated the exact reason JP Morgan is issuing warnings.
It just feels like a house of cards.
It's a phenomenon called vendor financing, and we are seeing a lot more of it in this AI boom. It inflates the economic optics for everyone involved. Plus, JP Morgan noted that this contract lacks hard guarantees that Iron will actually get these highly coveted chips in the volumes they need.
Right. Their stated target is what, 150,000 GPUs?
Yeah, 150,000.
So you have a company trading at a forward PE ratio of 63, which, by the way, implies flawless future execution. And they're facing massive capital expenditure needs, relying on a supply chain that isn't totally locked down. No wonder they just had to propose a $2 billion convertible notes offering. The volatility isn't an accident. It is baked right into the foundation of their business model.
It really highlights the stark difference between selling the underlying hardware you physically manufacture, like Micron, and trying to build a speculative business model on top of hardware you don't even possess yet, like Iron.
Yeah, huge difference. And what's wild is that the fight over this hardware isn't just a corporate turf war anymore.
No, not at all.
The silicon we are talking about has officially escalated into a matter of national security. The physical hardware builds the models, and those models are now fiercely protected state assets.
Absolutely.
I mean, we're seeing the latest AI models from American companies like Anthropic and OpenAI actively extending the United States' technological lead over China.
The global stakes have fundamentally shifted here. Last month, there was this quiet meeting in Singapore where representatives from a Chinese think tank approached officials from Anthropic.
Just a think tank, right?
Informally, yes. They informally asked for access to Anthropic's newest, most powerful AI model, and Anthropic flat out said no.
I mean, this feels like sending your friend to ask someone to the prom for you, just so you don't get officially rejected to your face.
That's a great way to put it.
But I'm curious, does this kind of backdoor think tank diplomacy actually work? Or does it just highlight how desperate the AI arms race has become?
Well, it definitely exposes the desperation, but, the use of the think tank is a classic intelligence gathering tactic. It is a trial balloon.
Oh, so testing the waters.
Right. If Anthropic signals any willingness to negotiate, the formal government apparatus swoops in. If they say no, the state hasn't lost face. But what you have to understand is what they're actually asking for.
They don't just want an API key.
No, they aren't just asking for a software subscription. They want the underlying weights of the model. Handing over an advanced AI model today is increasingly viewed with the exact same gravity as handing over highly classified military blueprints. A breakthrough in artificial intelligence directly translates to breakthroughs in cyber warfare, cryptography, and military logistics.
That makes perfect sense. So the compute power is being hoarded because it's a strategic national asset. But it's not just artificial intelligence that nations are stockpiling right now.
No, we're seeing it in crypto too.
Yeah, we are seeing sovereign entities treat digital currency with the exact same level of strategic importance. Let's look at the Kingdom of Bhutan.
This is such an interesting story.
It really is. Arkham Intelligence just reported that the royal government of Bhutan moved over 100 Bitcoin valued at about $8.2 million to an unlabeled wallet today, May 12th.
And this movement is part of a much larger systemic strategy. I mean, Bhutan has been actively cashing out, generating over $230 million in sales since January 2026.
But they still hold a lot, right?
Oh, yeah. They still hold a massive stack of over 3,100 Bitcoin, which is currently worth around $252 million.
The mechanics of how they acquired this are fascinating to me. They didn't buy it on an exchange. They didn't seize it in criminal raids like the U.S. government sometimes does.
Nope.
They mined it themselves using the surplus hydroelectric energy generated from their river systems. They took stranded natural energy and literally converted it into a highly liquid digital reserve asset.
It is arguably one of the most brilliant sovereign wealth strategies of the modern era. I mean, if they liquidated their remaining holdings today, They would lock in over $767 million in pure on-chain profit.
That is incredible for a nation of their size.
Right, and Prime Minister Trishering Tobgay has been very clear that these liquidated funds are being actively deployed for domestic healthcare and education infrastructure.
Building real things.
Building real things. But we also have to run the math here. At their current sell rate of roughly $50 million a month, their entire treasury could be depleted by September 2026.
Here's where it gets really interesting. Because while a sovereign nation like Bhutan is aggressively taking profits to build physical hospitals, Wall Street models are doubling down on hyper-bullish projections.
Oh, the projections are astronomical.
Yeah, Standard Chartered and veteran trader Peter Brandt are projecting Bitcoin to hit anywhere from $300,000 to $500,000 by late 2028 or 2029.
And the primary catalyst driving those massive projections is the incoming Trump administration's Project Freedom policy platform that includes plans to unlock banking liquidity and establish a strategic national Bitcoin stockpile.
And just to pause here, a mandatory disclaimer for everyone watching the stream. We are strictly neutral on these political policies.
Absolutely neutral.
We are not endorsing any side or Project Freedom. We are simply reporting the thesis driving the market models right now. We just follow the data.
Exactly. The market is attempting to front-run the possibility of the United States government becoming a persistent buyer of Bitcoin.
But to play this narrative, retail traders are taking on absurd levels of risk. They're piling into an ETF called MSTU and its sister fund, MSTX.
Those are wild products.
Yeah, this is a 2x leveraged daily target ETF on MicroStrategy.
MSTR.
Right. Because MicroStrategy is already a proxy for Bitcoin. Buying a 2x leveraged ETF on MSTR is like getting on a horse race. But betting on a guy who is heavily leveraged, betting on the horse. It's a derivative of a derivative.
We connect this to the bigger picture. The math behind these leverage ETFs makes them exceptionally dangerous to hold. They suffer from a structural flaw called volatility decay.
Decay, yeah.
Because the 2x leverage has to reset daily, the compounding math works against you in a choppy market. If the underlying asset goes up 10% one day and down 10% the next, the leveraged ETF will actually lose value even if the base asset ends up flat over the week.
So they just bleed out over time.
Right, they bleed out. These products are engineered for surgical, short-term trades, not for buying and holding. For long-term exposure, the institutional capital is flowing into safer spot ETFs like BlackRock's IBIT, Fidelity's FBTC, or ARK's ARKB.
But I have to ask, if a whole nation-state like Bhutan is looking at the current price and aggressively cashing out their Bitcoin to lock in real-world infrastructure, isn't it highly risky for retail investors to be piling into hyper-leveraged 500K bets?
That tension is the defining characteristic of this market cycle. You have state-level pragmatism, a government realizing that digital wealth on a ledger means absolutely nothing until it's converted into tangible benefits for its citizens, clashing directly with unbridled speculative market euphoria.
And that appetite for wild speculation isn't just contained to crypto. Retail investors are aggressively trying to force their way into the ultimate frontier of the private markets. Let's look at space.
Oh, space sector is heating up.
SpaceX is reportedly targeting an IPO as early as June 2026. And the valuation numbers being floated are just astronomical, around $2 trillion.
$2 trillion. And, that valuation is being driven by the revenue cash machine of Starlink, the operational success of the Starship rocket, and these new speculative ventures like orbital data centers.
Orbital data centers. It sounds like sci-fi.
It does. But what makes this upcoming IPO unique is the circulating rumor of a massive 30% retail allocation.
Because right now, secondary private markets are completely walled off. Only accredited investors can play. You have to prove a $200,000 income or $1 million net worth just to get access to platforms like Forge Global or Hive to buy shares from early SpaceX employees.
And even if you can get access, it's highly restrictive. The liquidity risks in the pre-IPO market are severe. You are buying an asset with zero public financial disclosures, relying entirely on opaque secondary market pricing.
You're flying blind.
Totally blind. If the valuation drops, or if there is a mandatory 6-month lockup period post-IPO, which is standard, by the way, you are completely trapped. And if SpaceX issues millions of new shares during the IPO, your early ownership stake gets instantly diluted.
So buying pre-IPO stock is basically like buying a house sight unseen, with no inspection, and signing a contract that says you can't sell it for 6 months no matter what happens.
That is exactly the risk profile. For non-accredited investors desperate for space exposure, the safer routes remain indirect. You know, closed-end funds like DXYZ or XOVR, or even buying legacy tech giants like Amazon, which is building its own Project Kuiper satellite network.
So we have retail capital desperately trying to buy into orbital infrastructure. And on the completely opposite end of the spectrum, we have the theatrical absurdity of GameStop trying to buy it, wait for it, eBay.
Yeah, that was a headline I had to read twice.
GameStop CEO Ryan Cohen formally offered $56 billion, a mix of cash and stock, to buy out the e-commerce giant.
And the board of directors at eBay rejected the offer outright on Tuesday, publicly stating that the proposal was, quote, neither credible nor attractive.
I mean, how on earth did GameStop plan to swallow a whale like eBay for $56 billion? How would they finance that?
Yeah.
Was this ever a real offer or just meme stock theater? Wall Street must be laughing at the sheer mechanics of this.
The mechanics are what Wall Street spent the whole week tearing apart. GameStop possesses nowhere near the cash reserves to finance a buyout of that magnitude.
Not even close.
Not even close. What you are witnessing is an attempt to use inflated, meme-driven equity as a currency to acquire a legacy business that actually generates reliable free cash flow.
So they need the cash flow.
Right. It is an attempt to buy fundamentals to justify their own overvaluation. It perfectly illustrates the surreal nature of modern capital allocation.
Surreal's the perfect word for it. Because while we are analyzing $2 trillion orbital data centers and $56 billion meme buyouts, basic financial gravity still exists, and it is hitting the traditional retail economy incredibly hard.
It really is.
So let's look at the basic laws of retail physics with Under Armour.
Yeah, the fundamentals of supply and demand have not been suspended, and Under Armour's latest earnings report is a brutal reminder of that fact.
Under Armour, ticker UAA, saw its stock tumble over 15% in pre-market trading today. They hit a 5-month low after reporting their fiscal fourth quarter 2026 earnings.
It was a rough print.
Yeah, they posted a net loss of $43.4 million, which is 10 cents a share. Total revenue fell 1% to $1.17 billion, with North American sales dropping a painful 7%, though I guess international grew 10%.
That's the one bright spot. But the underlying metric that should terrify investors is the gross margin compression. Their gross margin shrank by a massive 470 basis points, down to 42%.
So what does this all mean? Let's unpack the why behind that margin compression. Why are they suddenly making so much less money on every shirt they sell?
It is a direct combination of rising global supply chain costs and a sudden surge in import tariffs. When your costs go up by nearly 5%, a healthy brand simply raises prices to protect their margin.
Just pass it on to the consumer.
Right, but Under Armour doesn't have the brand equity to command higher prices. They are fighting a two-front war here. Dominant athletic competitors like Nike own the performance tier, and hyper-focused lifestyle brands like Lululemon own the premium athleisure tier.
So if Under Armour raises prices,
Their customers simply walk away.
while Silicon Valley is building trillion-dollar orbital data centers, Under Armour is losing money trying to sell T-shirts. Gravity still applies.
It does, and the future guidance reflects that reality. They're projecting a bleak 8 to 12 cents per share for fiscal 2027, completely missing the 23-cent Wall Street consensus.
That's a huge miss.
Huge. They are also forecasting another revenue decline next year. So returning CEO Kevin Plank is attempting a massive triage operation. They are taking a $36 million restructuring charge and slashing their product lineup, their SKUs, by a staggering 25%.
But wait, is slashing your product lineup by 25% really the way to win back customers from Lululemon? Or is that just a desperate move to stop the bleeding?
This raises an important question. Because cutting 25% of your product line fundamentally means giving up highly valuable physical shelf space at major retailers like Dick's Sporting Goods.
Oh, and once it's gone.
Once you surrender that physical footprint to a competitor, it is incredibly expensive to win it back. Can you realistically shrink your way to growth? Historically, no. You can shrink your way to profitability, but not growth.
Right.
When tariffs and supply chain constraints compress your margins, eliminating dead weight is necessary for survival. But a successful brand turnaround requires giving the consumer a compelling, unique reason to choose your product over the established market leaders. Right now, the consumer is financially stretched thin, and Under Armour hasn't provided that compelling reason.
It truly is a staggering duality in the markets today. I mean, on one screen, we are watching seemingly infinite capital eagerly flow into AI memory bottlenecks, pre-IPO space exploration, and hyper-leveraged Bitcoin derivatives.
Yeah, endless capital.
But set directly against that, we have the undeniable fundamental cost realities that are actively crushing traditional retail brands.
Hmm.
We're watching two completely different economies operating simultaneously.
We really are. And it leaves me with one final thought for you to consider as you watch these live feeds today.
Okay, let's hear it.
Earlier, we discussed how fiercely companies like Anthropic are protecting the newest, most advanced AI models from foreign intelligence.
Right.
But what happens to market stability when those exact same hyper-advanced cognitive models are eventually turned loose by hedge funds to autonomously trade these incredibly volatile assets?
Oh, wow.
Imagine a sophisticated AI model autonomously trading a 2x leveraged Bitcoin ETF, or maneuvering through the opaque valuation of a pre-IPO space stock, executing thousands of decisions in milliseconds. Are human investors about to be entirely priced out of the sheer speed of the market?
That is a chilling thought. I mean, if you think the volatility decay on an ETF is hard to manage now, imagine competing against an intelligence that can process the entire global supply chain in the blink of an eye.
It's a whole new world.
It definitely makes understanding the fundamental why behind these market moves more critical than ever. Well, thank you so much for joining the stream today. We hope you got some clarity out of the chaos. Keep an eye on those live spark lines. Have a great day, and we'll see you next time right here on NovaStream.